Tyler, the tariff saga continues to play out and increasingly creating concerns about recession. We don't know if recession is going to happen or not in the near term. Eventually, a recession is going to happen. The question is just how quickly it's going to be. But we do know one thing for certain is that really high quality dividend stocks can be a great way to weather economic storms, generate income through those periods. Some of the best ones grow those income streams on a pretty regular basis. So we want to talk about a couple of stocks, whether you're particularly worried about a recession right now as imminent or just thinking and planning long-term as a defensive investor. We've got a couple dividend stocks we want to talk about today.
Yeah, we're talking about it in the context of a tariff sort of recession, but recessions come in all types of all flavors. And these are two companies that can probably handle a wide variety of recession types for one's portfolio.
Yeah, that's exactly right. We're going to get into it with a couple of great stocks here. But if you're looking for more great stock ideas, go to our special link. This video is sponsored by The Motley Fool. That special link is fool.com/unscripted. Go to fool.com/unscripted, and you can get access to the Motley Fool's 10 best stocks to buy right now. Tyler, companies we're going to talk about today, some of the things that they both share is that they're definitely very economically resilient. The services that they provide to the customers that they provide them to, these are necessary across the economic spectrum. No matter what's going on in the macro environment, the services they provide are critical to the industries they serve. And the fees that they generate are pretty insulated from changes in interest rates, things like inflation. They're going to get their money pretty much no matter what happens. You can almost think about their businesses as air. Nobody thinks about it until it's been taken away. So that's a position, a couple things that they both have in common. Let's start with yours. It's one of the most important companies in the energy infrastructure business in North America.
Yeah, it's Enterprise Products Partners, which is I'll confess right at the beginning, it's a master limited partnership. It's not a corporation. So anybody who's interested in such company, just remember there are tax implications. I feel like that's a disclosure we have to do with all of these. But as a master limited partnership—
Spoiler alert, the one that I'm going to talk about, there's a corporation you can buy. So stick with us if Enterprise doesn't work, or you can scroll ahead a little bit.
As you kind of suggested, this is an energy infrastructure company, mostly pipelines, some processing, a little bit of export, all the stuff in between the exploration production phase and the refining marketing phases for mostly petrochemicals. The largest percentage of their portfolio is for what are called natural gas liquids. So think like propane, butane, and a lot of those similar products, which are also tend to be like feedstocks for plastics and a lot of other chemical companies and things like that. They're the big name in the game for this particular type of petroleum or fossil fuel across North America, which in the time of shale is pretty important because a lot of shale production is very light and produces a lot of these natural gas liquids. So as you suggested, energy infrastructure companies, pipeline companies, they tend to operate on very what are called take or pay contracts, which basically means somebody doesn't pay for the use at the time of the use. It's like a contract that says, look, we're going to dedicate this much space in our pipeline for your product. You're going to pay us whether or not you use it. It's your reservation at the table. You actually have to pay for your dinner before you actually even sit down. And
it's
so
like the retainer, but the retainer for the attorney that pays for the entire service they provide.
Exactly. And so you have that in line. So you get these relatively immune from commodity price fluctuations, at least on the bottom line of this business. There's some wonky revenue things. Anybody who's looked in their financials will think, well, that's kind of weird, but that's revenue recognition is slightly different because of commodity prices. But the actual bottom line, the funds from operations or the cash flow from operations is all based on these take or pay contracts that they mostly have. It is a business that I think if you look at it over the long term, it has been run for very stable dividend growth or distribution growth with that a lot of touches of the founder-led business that it was a long time ago. It's no longer founder-led, like the Duncan family, who is the family of the founder of the company, has their trust is like a large shareholder in the business, and they're the board of directors. And they very much run this business in we want a stable payment to us every quarter that rises ever so slightly. And we want our managers to run this business in that exact way. And you see it in their financials. They keep a relatively modest amount of debt relative to the energy infrastructure industry. They tend to be pretty conservative with underwriting new assets or underwriting a new project to develop, whether it be a pipeline or a gathering system, whatever have you. And for the most part, over their history, their payout ratio has been quite conservative relative to the rest of the industry. So all of these things suggest this is a company that's built to handle the ups and downs. And the thing that actually gives me the most confidence in its ability to handle the ups and downs and weather the recession storms is that high ownership from the family trust, which is basically running it in a sense of we're not looking to push this thing too far and try to push an unsustainable payout that's only going to get cut later. This is supposed to be generational wealth for us, and we're going to manage it in that way. And for somebody who's looking for something in a time of not crisis, but recessionary times, stressful times in the market, there's a little bit of confidence in that management style.
Yeah, I think that's right. And if you have the right expectations for what you can get for returns, Enterprise is really attractive. I don't know that it necessarily is built to be a market beater over the long term, especially during a strong bull market where we're getting 10% plus returns. But as a starting point, the dividend yield is right around 7% on a forward basis, Tyler, going forward. That's certainly lower than it has been at periods over the past 10 or 15 years. But you look at the past 6 months from the from November, from the presidential election, energy stocks as a category went on just a strong run. And then here, since the beginning of April, the wind has gone out of the sails as oil prices have come down. OPEC Plus has talked about increasing production, further things that have affected it. And the funny things that a lot of those realities are generally not, they're material for Enterprise, but they're not going to upend its cash flows, right? They're probably not going to affect its cash flows in much of any way at all. And that's created a better buying opportunity to, again, lock in that 7% yield, get that relatively modest dividend growth on an annual basis. And just as the enterprise becomes more valuable over time, based just on inflation and the increased value of those assets, get a little bit of a bump in the per unit price, the per share price there. I think there is something to like. But like I said, it's a master limited partnership, and that doesn't fit for every investor. If you're investing in a retirement account, your broker might not let you buy it, and you might not want to anyway because of tax implications, like Tyler said, even in a retirement account. So I want to talk about Brookfield Infrastructure. Now, Brookfield Infrastructure was founded and started as a publicly traded partnership. That's BIP. But you can also buy Brookfield Infrastructure Corporation. That's BIPC. So you have the way to invest in this if you're trying to avoid owning any of those publicly traded partnerships and their Schedule K-1s and their tax complications. Why Brookfield Infrastructure? A couple reasons. Number one, it exists as part of the empire of Brookfield entities to serve a really important role, both as a source, as a place to allocate capital, but also to manage assets in the infrastructure space that are co-invested into by Brookfield Asset Management and the funds in Brookfield Asset Management. So it serves a really important operating partner role for the Brookfield entities in the asset management business. And in its case, infrastructure assets. You think about things like moving large amounts of goods. So like moving water, moving energy is becoming an increasingly large part of their business. Just made a substantial investment as a partner to acquire the Colonial Pipeline, which is one of the most important refined products pipelines in the eastern U.S. and the southeastern U.S. Data, telecommunications, thinking about more the modern future of infrastructure, very involved in those things. Just like enterprise products, a lot of those different assets that it owns, they're fee-based, right? So they generate based on the volume. They get their fee structures, and a lot of them are take or pay structured as well. So really high quality businesses with long-term secured, predictable cash flows. Here's a kicker. Enterprise Products operates in North America, almost entirely in the US. And you look at Brookfield Infrastructure, and it operates in a couple dozen countries. It is not entirely exposed to just the US or North America. It's about half of its business. So it's got lots of opportunities to invest in infrastructure around the world. And as infrastructure around the world expands in developing nations, and as it becomes more modernized in most of the Western countries, there's going to be trillions of dollars of capital flowing into infrastructure over the next few decades. So it's positioned to partner with its capital partners to be involved in those big trends around infrastructure that makes it really compelling. Similarly, we've seen its stock price come down over rising interest rates and concerns about economic pressures and inflation around the world. The dividend yield for Brookfield Infrastructure Corporation's close to 5% right now. So really compelling yield, great long-term dividend growth story here, growing that payout above inflation pretty consistently most years, 5 to 9% dividend growth really compelling business to buy. So that one is right at the top of my most compelling stocks writ large to buy right now. And certainly for investors looking for dividend stocks, dividend growth stocks on top of that, I think Brookfield Infrastructure should be at the front of the list.